Good morning, everyone. Thank you for joining us on this Saturday morning, and welcome to this Specialist Trading educational presentation. Now, today I'd like to talk to you about a statistic that has actually been correct over 80% of the time. And when I say over 80% of the time, this is something I've been actually tracking for decades, and it still is valid. It's a really important statistic, and you can actually start using this stat that I'm going to share with you today and apply it to your own trading as early as Monday if you'd like. And you're going to see how you can actually use this stat on our platform. This is the PTS Primo charting platform, the educational platform that actually teaches you how to trade. So welcome once again. My name is Steven Primo, president and founder of Specialist Trading. If you're new to my webinars, we are all about one thing and one thing only, and that is strictly just educating you as a trader. In other words, if you've come here today, like other webinars you may have attended in the past, from other so-called educators, and you're thinking of finding out what I think the market's going to do next week, or what I think the best stock is to buy or either sell, or what I'm going to tell you is the perfect time frame to trade, you've actually come to the wrong place, because that actually goes entirely against our philosophy. You see, most traders make their trading decisions either by going to a webinar or going to a chat room or a trading room or waiting for the earnings or jobless claims to come out or listening to someone on TV. You see, all those things are based on you taking or making your decisions off of what someone or something else is telling you. And this is why I believe most traders fail. What we really want to do is put you in charge of your own trading. And the only way you can do that is by making your own decisions and by actually educating yourself. That really is the holy grail to trading. So that's what we do at Specialist Trading. We're really just simply trying to educate you so that you don't have to rely on anyone or anything else. You can really just look at a chart, use a few simple tools and some structure that I teach in my courses, and you can decide for yourself what you think the market is doing. That, in my 43 years of trading, is the only way one becomes a consistent trader. Most of the consistent traders I know, traders that have not been trading for just 5 or 10 years, but for decades, 20, 30, 40 years, they make their own decisions. They don't look at news. They don't wait and go to a chat room to find out what someone else is doing. They don't read blogs. They simply look at a chart based on a few simple rules and make their own trading decisions. And this is what has sustained them. So this is what I want to instill in all of my students around the world in over 115 countries and in every state in the United States. This education that has stood the test of time. Now, I can teach you this because I've been trading for 43 years. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for 16 years, and out of those years I was a specialist. That's where we get the name Specialist Trading. So I specialized in making a market in about 60 stocks. So I traded through the crash of 1987 and the bull market that followed. So I've seen just about every market environment. I've traded just about every system or strategy you can think of. So I'm here so that you don't have to waste your time searching for that holy grail, and most of all, spending thousands, if not hundreds of thousands of dollars searching for it. With just a few simple tools, and especially things I'm going to be teaching you today, you can start to take charge of your own trading destiny. So you'll see that attention to detail we give in today's educational class. Now, before we begin, as always, we are first required by law to share this with you, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results using these tools and sharing this statistic with you, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. Also, please remember that all examples are strictly for educational purposes only. Once again, we are first and foremost an educational company, and if you're looking for more education on a daily basis, I invite each and every one of you, if you haven't done so already, to follow us on Twitter. There's our handle there, abbreviation for Specialist Trading. I suggest copying that down because every day I post different educational little bits of wisdom to financial wisdom to showing signals our strategies have generated and sharing with you why they were generated. And so lots of great free educational information on a daily basis. Feel free to follow us on Twitter. Okay, so as I stated in the opening statements, we're a little bit different from other webinars you may have attended. We are only here to educate you. That's our only goal. So as you can see, my goal is not to force feed you signals, not to tell you what market to trade, or not to tell you even what I think of the market's going to do. That would be doing you a disservice. A good mentor does not trade for you. A good mentor teaches you how to trade. So that's my goal, to teach you how to trade with the specialist ed. Now, when I first started trading some 43 years ago, I was struggling tremendously. If you're struggling right now, I know exactly what you're going through. It's very frustrating, very disappointing. spending a lot of hard time and hard work trying to search for that perfect methodology that fits your trading style. Also, you're spending a lot of your own money as well. So I know exactly what this is like. Now, I was lucky enough to have some mentors on the floor of the Pacific Stock Exchange who saw how much I was really struggling with trading, and they turned my trading around. This is what we call the specialist edge. They taught me this edge, and this is the same edge I teach all my students. So hopefully it will be able to sustain you now for going on 43 years, all right? Now, since we are an educational company, and as an educator, I want to answer as many questions as possible, but please wait till the very end of class. I have a lot of slides to share with you, and I'm going to do something a little bit different. We're going to look at some up-to-date charts as well, sharing with you this technique and this statistic. So if you have a question, please wait till the very end of class, probably in the next half hour, and then we'll go through all the questions. The only question I will answer right now is this being recorded? Yes, it is. We record all of our webinars, so if you have to leave early or if you're having technical issues, many times it's your internet connection. All you have to do is log off and then log back on. But if you're still having issues with your, seeing the screen clearly or hearing my voice, we will send each and every one of you a link to this recording. Okay? So once again, if we have a good crowd here today. If you have any questions and you came in late, please wait till the very end. All right, so let's begin and let's talk about this statistic. Remember, I have been tracking this for decades now, and it never fails. It's extremely valid, and I want to share this with you so you can start applying it to your own personal trading as well, and hopefully it will help you the way it helped me. And here are the stats. And actually, this is the only statistic I ever look at. A lot of you know that I don't follow statistics. I really don't believe in them. Here's the only one that I actually do believe in because it's it's correct over and over and over again. And here it is. 80% of all traders lose money. I know it's a little hard to take, but that stat has never failed since I started trading over 4 decades ago. 80% of all traders will fail. And when I say fail and lose money, this statistic does not mean, well, sure, you'll have a bad week or a bad month. No, 80% of all traders usually lose everything, all the money they've set aside for trading in the first year. Okay? Now, the facts also state with this statistic that 15% of all traders will break even. Okay? And that's actually not bad. If you've been trading for a couple of years and you're breaking even, that's actually pretty good because you're not losing anything and you're learning along the way, but you're still putting in a lot of hard work and a lot of money, and you're basically just treading water. So ultimately, this means that only 5% of all traders, 5%, will be consistently profitable. Now, if you want to see what that looks like on a pie chart, as we can see here, that large section in red represents the percentage of traders that will ultimately fail. That blue slice there represents the amount of traders that will break even, and that small little green sliver represents the percentage of traders that will ultimately and consistently be profitable. I mean, think about it. We have a good crowd here today. We have close to 100 people. This statistic means that 80 of you will ultimately fail. That only 15% of you, or 15 of you, of all the traders listening today, will break even, and only five of the attendees listening today will be consistently profitable. So you have to ask yourself, how is it possible that the majority of all trading profits are captured by such a small percentage of traders? Now, if there's one thing I've learned since I started to turn my trading around, and since my mentors taught me these things, is that most traders think that there's a finite source of profits to be made on a daily basis, that there's only so much to go around. Now, that is, I used to think the exact same thing, but that is totally false. That's really a negative way in which to view the markets. That would be comparable to saying, well, there's only a finite, air supply every day. So for every breath you're taking in, someone is losing a breath. I mean, that's silly. Why would you think of it that way? There is enough oxygen to go around on a daily basis. It's the same way with profits. There is an indefinite amount of profits to be made on a daily basis. It's just it's never ending. But we look at it as if it's a finite source, and we look at it as if it's something that it's going to be gone by midday and that there's no more profits left, or someone beat me, they won and I lost. And that's a really silly way to look at the market. There's more than enough for everyone to go around. on a daily basis. But why is it that only a small percentage are able to capture it? Well, it really is simple. It's not that difficult of a question to answer. And here it is. These traders, whether they know it or not, know the importance of being in sync with the market. You see, that's everything. You have to want what the market wants. I mean, think of it. Would you rather go against the tide? Would you rather swim upstream against the current than have the current at your back and swimming downstream? You see, it's the same way with trading. Most traders are trying to pick tops and bottoms, and they're swimming upstream, going against the current. And that's why trading is so difficult, and that's why they fall into that 80 percentile group. Let's look at this example right here in UI. This is the way most traders, myself included, I'm not putting myself above anyone else. I did the same thing. But this is the way most traders would trade, using conventional wisdom, things that we were all taught that are supposed to work, but really don't show any levels of consistency over time. For example, someone looking at this after taking some courses or after studying for a while would say, well, okay, looking at this chart, we're in an uptrend in the beginning of this chart. After all, we're making higher highs and higher lows. That's the definition of an uptrend, right? So things are going pretty well. So we've got to buy this stock, or you've got to at least think of it from a buyer's perspective. But then at this point, look what happens. We kind of run into a brick wall. This is what's called resistance. This is where we're taught. This is where the institutions are selling. All the big banks, they have all the large amounts of cash on hand. So we don't want to go against them, right? Excuse me. They're the ones that control support and resistance. So most likely, we're not going to get through that unless we get some big buyers. So we should probably just sit back and wait. And on top of that, let's look at some pattern recognition. I took that $10,000 course on candlesticks. And what do we have here? That's a bearish engulfing pattern. That's a reversal pattern that you find at the top of a trend, usually telling you that the trend is going to reverse. In this case, it's going to go down. And not only do we have one of those, we actually have two of them. So that's a really, really bad sign. So we have resistance. The trend seems to have stopped. We're no longer making higher highs. We're now making lower highs. We have resistance with the institutions, and they're never wrong, right? They're right there selling. And we have two bearish engulfing candlestick patterns. So for all intents and purposes, we're making lower highs and lower lows. We're now in a downtrend. So you don't want to buy this. We want to stay away from this. Or if we're a little bit more aggressive, we would actually decide to sell. So here's our analysis. What we've learned, all the things we're taught, conventional wisdom, is supposed to work, right? The market is going lower. Therefore, we want to sell. So we decide to sell. We want to be in sync with the market, right? Steve says you should be in sync with the market, with the trend. You don't want to swim upstream. You want to swim with the current at your back. And the current is currently going down. So we decide to sell. Feel very confident. Feel we're going to make a lot of money. And then this happens, right? What happened to all that conventional wisdom? What happened to all the things we were taught that are supposed to work, right? I remember when my mentors taught me, they said, Steve, there's so many things there are that really aren't. Meaning that we've taught so many traditional rules, so many things that are supposed to work, but they really don't. For some reason, they're almost like an urban myth. They really don't hold any validity. So being consistently out of sync with the market is the root of all of your losses. I mean, think of it. If you buy something and it goes down, obviously you're out of sync with what the market wants to do. And if you sell something, you short it, and it goes up, obviously you're out of sync. So being out of sync with the market is at the root of all your losses. That's all it is. It's that simple. So these traders who are able to consistently generate profits, these 5%ers, they have a way of knowing how to really be in sync. Obviously, they're not following the conventional wisdom that we were taught, because as you can see, there's really not a lot of consistency in that. What if I told you, though, that there was a tool that was designed to automatically put you in sync with the market? All right? What if there was a tool that you were able to use right now that would automatically put you in sync with the market? Guess what? There is. I know before you think, well, yeah, okay, here's the hook. I've got to spend $5,000 to get this special tool that Steve has devised, and I've got to, subscribe to some website. It's going to cost me money, but this major indicator is supposed to tell me what direction things are going or what direction they're not going. I get it. This is a sales job, right? Not really. In fact, you have it at your access right now. It's the buy-sell line, because it tells you whether you should be a buyer because the market is going up, or a seller if the market is going down. And you have it at your access right now, because all the buy-sell line is the 50-period simple moving average. Here's the problem. Most people use the 50-period simple or any moving average, actually, in our opinion, they use them incorrectly. Most people use a moving average to help them decide as a crossover when to buy or when to sell. We're going to use it just as a tool to tell us whether we should be a buyer or a seller. It doesn't tell us when to get in, doesn't tell us when to get out, doesn't tell us how high something will go or how low. It's just telling us what our bias should be, our perspective on the market, whatever time frame we're looking at and whatever market. All right. In order to use the buy-sell line correctly, all you have to do is ask yourself this question before each trade. But you must ask the question. You cannot enter a trade and then ask this question later on. You have to ask before you pull the trigger. And it's extremely important. Ask yourself, where is price in relation to the buy-sell line? Okay? I'll repeat that again. Where is price in relation to the buy-sell line, the 50-period moving average? I would suggest writing that down and putting it on a little post-it on your computer screen, okay? So that you can make sure you remember this. Because it's really simple. If price is above, then you will only have a buyer's bias. Remember, this does not mean if price is above, you buy at the market. It just means you'll look at the market from a perspective of a buyer. But if price is below, then you will only have a seller's bias. You'll look at the market from a seller's perspective. And right there, you have just eliminated just about half of your issues, half of the problems, because you are now in sync with the overall trend. All right? All right, so let's look at the buy-sell line process. Let's see how it works to show you how valuable this tool is. Remember, you most likely, regardless of what platform you're using, regardless, even if you're going to an online chart that you get for free or something with your broker that has supplied you with, you can apply a 50-period moving average to anything. All right, let's look at that UI chart that we looked at earlier, okay? Remember, our analysis originally was the market is going lower. We were going to sell because we thought we were going to make a quick buck here to the downside. Here's the first thing we do. We ask ourselves, where is price in relation? Because obviously it didn't work very well. Well, on our platform, we have it right here in the upper green strategy tab, the buy-sell line. All you have to do is click that on. You'll see a drop-down menu appear. Click on 50-period simple moving average. We have a total of 4 different ways in which to view it. Let's click on the simplest one, the 50-period moving average. It doesn't matter what time frame, what chart, what market. This could be the futures. This could be a tick chart. It doesn't matter. You always want to plot a 50-period moving average. And now ask yourself, where is price in relation to the buy-sell line? Remember, you wanted to sell. Is that the right choice after knowing this simple rule? Obviously not. Price has been above the entire time. So where we thought originally we were in a downtrend, that was actually a buying opportunity. So there's no way we should have been selling at all. All right, let's look at this example in PINS, P-I-N-S, all right? All right, so we're looking at this because we say to ourselves, okay, well, my analysis is we've got major support here. I took that $10,000 class on the institutions, and I got that great indicator they used and telling me what the institutions are doing and the volume, and this is major support. On top of that, this is Fibonacci support and Elliott wave support. And you can see the market wants to hold here, so I'm going to be a buyer. I mean, it can't go against the big bucks, right? Did you see how all my justification was made off of what someone or something else is telling me what to do? What's the market telling me what to do? After all, shouldn't I be listening to that? First thing we want to do is, if we were thinking about buying, well, we want to check our work. Remember, you have to check to find out where the buy-sell line is before you buy or sell. All right, so we want to be a buyer here, right? What happened? What happened to the institutions? What happened to all that major support? Okay? What happened to the LA wave Fibonacci support there? First thing you would have done, rather than just listen to these outside sources that hold no levels of consistency, is to click on the buy-sell line. In the drop-down menu, click on 50-period moving average. And now before you pull the trigger, either way, buying or selling, ask yourself, where is price in relation to the buy-sell line? Price was below. So are you going to have a buyer's perspective if price is below? No, you're only going to have a seller's perspective. So there's absolutely no way you should have been buying there. See how powerful this tool is. Remember, you all have access to it. There's nothing you have to pay for. We're not selling you anything. You can start using this right now. All right, now rule of thumb, extremely important. Look for at least 3 to 5 bars to close either above or below the buy-sell line before an overall trend is established. This is probably one of the most common mistakes our new students make. They say, well, Steve, we were below the buy-sell line, but then I had 1 bar close above, and then my strategy generated a buy signal, so I bought at the market, and it still went down. Well, remember, there's no guarantee that every setup, regardless if it's valid or not, is going to work. But if you want to make it more valid, you have to have at least 3 to 5 bars closing above or below before you can determine what the perspective is. You can't just say, well, 1 bar closed above, I guess we're looking at the market to go long now, right? Or 1 bar closed below. Let me show you what I mean here. Okay, we're looking at a chart here, a BIG. Now, price is originally above the 50-period moving average, and then we start to go below. So we count how many we have closes. 1, 2, 3, 4, 5. So this is enough to tell us that the overall trend has changed. I know beginning students would tell me, but Steve, there's not enough information there. How do I know that this thing should be looked as a seller's perspective? It still seems very strong, and all the earnings just came out. They're really good. That guy in that chat room I go to really loves this stock. He says it's going to double by summer. So I've got to, think of this as a buying perspective. Well, you can do what you want. We're just trying to educate you, because look what happened. The stock fell 15 points in the next month. So we're not saying you have to short it, but don't you think you would have saved yourself a lot of money and heartache and sleepless nights by not buying it there? Now, as the trend starts to change, as the river starts to change direction, price starts to flow up, and now it starts to flirt, oscillating above, below the buy-sell line. And then what do we have here? 1, 2, 3, 4, 5 closes above. And someone would say, but Steve, that's not enough. Look at, we just bounced, we just filled this gap right here. It looks like we've just bounced and we're going to go lower. Well, it may be right. We don't know. But the odds are in our favor that it's going to go higher. And look what happened after that. Now, as you can see, price actually did double. So that analyst you saw maybe in the chat room or on TV was correct, but his timing was faulty. You see, most traders, even if they believed in somebody said price was really going to double or really soar, would you have enough wherewithal to hold on as you lost 15, 20 points? Most of you would say, I can't take this loss anymore, I'm getting out. But what if you just said, well, I'm going to wait. I think the guy is right, but I'll wait till price goes above the buy-sell line. Well, you could have gotten a better price somewhere down here and, seeing that the stock actually did jump up. Here's another example here. This is an older chart of Merck, okay? Originally, we were above, and this is what I want to tell you about how this is not something that is to be guaranteed that you'll never lose. Nothing in the market exists that guarantees you will never lose or that it will work 100% of the time. Trust me, I've been trading for over 4 decades now. I've never seen anything that works 100% of the time or is perfectly guaranteed. We're just trying to put the odds in your favor to give you that edge, okay? So an edge doesn't require that it has to be 100% foolproof. So as you can see here, as Merck crossed above the 50-period moving average, let's say your strategy generated a buy right here on this little breakout. And maybe for a week or so, you had a nice little profit, but now it's giving it all back, okay? Now, if you haven't exited the trade yet, well, the market is telling you, listen, you're going to have to take the loss, because if you don't now, it's going to hurt a lot more in the future. Because what do we have here? A total of 1, 2, 3, 4, 5, 6, 7, 8, 9 closes below. So rather than hold on, just take the loss, because look what happened. It would have turned into a major loss if you held on to the trade. So the market is always trying to give you signs of what it wants to do. Here's the trouble. We don't usually listen to the market. We're always trained to listen to what some guy says in the chat room, or what some guy says on TV, or what some earnings report is supposed to be, or some jobless claim. We never listen to the market, but that's really what we're supposed to do as traders. We're not supposed to listen to an outside source. Remember, 80% of traders fail. I think one of the main reasons is you're out of sync. And why are you out of sync? Because you're listening to a source that really has no level of consistency. Listen to the market. It's a lot simpler, a lot cheaper, and you'll be, for the first time, in charge of your own trading destiny. Now, I know a lot of you are saying, Well, yeah, Steve, you cherry picked a couple of examples here. Sure, I worked on those examples, but I don't trade stocks. Maybe I trade 5-minute bars of future. Maybe I trade currency pairs. I don't really believe this is that important. Maybe you just picked some examples that it worked perfectly on. Okay, well, I totally understand. In fact, those exact same words I said when my mentors taught me this same concept 40 years ago. But let's look and see how important it is. Let's go back in the past, all right? Let's look at this chart here. This is a chart of the Dow Jones Industrial. This is when the market was going really up in a nice uptrend and then started to have a little trouble here. See how we were kind of oscillating up, down, but we're still doing well, okay? Here's the only trouble with this chart. Look at the date down here. This is October 1987. Does that ring a bell? I know a lot of you don't know what that is, but that was the crash of 1987. I was a market maker. I was a specialist on the floor of the stock exchange then. I was making markets, okay? Let's apply the buy-sell line. All right, so as we can see, this uptrend was valid. It was above the buy-sell line the entire time, but look at what started happening a month or so before the crash. We started oscillating below, above, below, above. And so what does this mean when the market is doing that? It's showing you that there's uncertainty. The market is trying to make up its mind what it wants to do. And it's really not that positive of a sign. So if you were long, maybe you would think, you know what, maybe I'll protect myself and move my stop up. Or you'd say, you know what, if I were thinking about buying some more shares or buying a new stock, maybe I'll hold off a little bit. Because look at the examples here. You had like 3 closes below, then you closed back above for 3 bars, and then you had about 8 or 9 closes below, and then you closed back for a few bars as well, and then you had 3 more closes below. So in my mind, after seeing this for decades, this is a very negative sign. And then ultimately, look what happened, okay? Now, the crash of 87 would have been comparable to a one-day market drop of 5,000 points today. Think of it, if we were down 5,000 points in one day. And here's one thing that most people don't understand. They think that this means from here to here, 5,000. No, the crash was this one day. So do you see how you had a full 2 weeks advance notice to get out of the market before the crash happened, okay? Let's look at another example. Here are the spiders. Here's a weekly chart of the spiders. Kind of the same thing. We're above the 50-period moving average. But now we start to oscillate below. We have 3 closes below, a couple of closes above, 1 close below, 1 above, and then 3 below. This is once again the market saying, I'm starting to make up my mind as to what direction I want to go. I haven't done it yet, but look what the time frame is. This is January 2008. Does that ring a bell? Okay, January 2008, the financial crisis, the last really strong bear market we had, the beginning of the bear market. And look at all the closes here. So this is the market once again giving us a warning. It's not clearly definitive that it's saying the market's going to crash or that we're going to go into a bear market. It's just telling us to be careful. So what a great tool to have in December, or I should say actually November and then December of 2007, telling us to be careful. There's some indecision now going on in the market on a weekly time frame. And then we all know what happened after that. This is the beginning of the 2008 financial crisis, a bear market that lasted for about 2.5, 3 years, okay? So do you see how powerful this is? One more example. Here's another chart of the spiders. Look how well we're doing here, doing really well in this market. And look at the time frame. January 2020. This is the beginning of this year, just about 11 months ago, okay? Do you see how strong the market was doing? Why? Because we're above the buy-sell line. But look what happened here in February. 3 closes below. What is the market telling us? Is it telling us it wants to go higher? No. Remember, ask yourself, where is price in relation to the buy-sell line? The market was telling us this is a negative sign. You may want to get out, or you may want, if you're more aggressive, think about shorting, because we all know what happened in March. The Dow fell a total of almost 9,000 points in 1 month, 8,700 points in 1 month. Phenomenal number, okay? We all remember that. Most people lost money. Why? Because they were out of sync with the market. Remember, being out of sync with the market is at the root of all your losses. So do you think this simple tool could have at least helped you? Maybe you were thinking about buying some stock. Don't you think that would have told you, you know what, I'm going to hold off a little bit here? Or what about if you're more aggressive? What if you thought, you know what, this is a bad sign, I'm going to look to go short? One thing we have to stress though, this is not a system. I don't want you to think, wow, this is amazing. I'm going to start using this on Monday. The first time I see price trade above, I'm going to just buy at the market. Or the first time I see price trade below the 50, I'm going to sell at the market. No, that is totally incorrect. That's the improper way to use the buy-sell line. Remember, it's only supposed to give us perspective. It's only supposed to give us a bias as to what the market wants to do and how we should be viewing the market. So in other words, if we are below, then you should only have a seller's perspective. If we are above, you should only have a buyer's perspective. For example, look at when the market was rising, but then we started to sell off here. All right, this is where people get scared. But because we're above the 50 period, you should have been looking at this as a buying opportunity with your strategy, with some method, some technique, because look what happened after that. We started to make higher highs. Now, as the market started to sell off again in the spiders, the ETF that represents the S&P 500, sure, you could have had this buyer's perspective again, but once we started having consecutive closes below, that's your cue to turn your perspective around and to say, you know what? I'm going to take my losses here because they may turn into major, horrendous losses if I continue to be a buyer. Remember, being out of sync with the market is at the root of all your losses. Okay, now, you still don't believe this? Go back and research your last 10 to 20 trades. I don't care what strategy you're using. I don't care what system it is. I don't care what it's based off of. It could be based off news. It could be based off the tides of the ocean. I really don't care. But add the buy-sell line. I can almost guarantee your losses will be due to the fact that you were out of sync with the buy-sell line. So if you still don't believe how powerful this tool is, go back and do the research. Look at your own trades. This weekend, you have all weekend to go back and look at price and see how it could have helped you by adding this simple tool. Now, here's the problem with this. Most people like yourself who are new to this webinar will be looking at this and say, boy, this is amazing. I'm going to go and start using this Monday. This is unbelievable. And they'll use it for a little while. This is a problem that most traders, myself included, when I first started trading, your eyes will light up and see, this, you found the Holy Grail. This is amazing. And then after a month, maybe after a couple of months, maybe even after a couple of weeks, someone will come up with the next Holy Grail, the next perfect system that all you got to do is press this button and it automatically spits out buy and sells. And guess what? You'll forget all about the buy-sell line. It'll go out the window because, you're searching for that home run. And the buy-sell line is great, but it's just a technique. It's not really telling you where to buy or where to sell. It's not really giving you an actual, plan. It's just giving you the perspective. So it all goes out the window because people forget about it. Even though they may have the 50 period still plotted, they'll forget about its function, okay? Well, because of this, I developed the PTS Primo charting platform with Pro Trader Strategies. We developed it to make trading simple and educational so that you could never forget about it. It would always be there. So what we want to do now is look at a bunch of current examples, up-to-date charts that I'm going to be sharing with you and show you just a list of these, how you can apply our new feature. This is called the fluid feature. This is something that automatically plots the buy-sell line on your screen, and it colors if the screen, or I should say, if price is above the 50, the back of the screen is colored blue. If price is below the 50, the bottom of the screen is colored reddish-orange. So that way you always know whether you should be coming from a buyer's perspective or a seller's perspective. But before we begin, once again, I'm going to show you a lot of performance results using our PTS Primo charting platform, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. And what I'm going to be sharing with you right now are strictly for educational purposes only. They're in no way to suggest or advise you to buy or sell any issues. All right, so let's look at these charts here. Here's a chart of the spider that we talked about, right? Okay, now if we want to add the buy-sell line, what do? On our platform, you simply go, this is our green strategy tab right here, right? You go all the way to the far left and click on fluid. Now, do you see how the screen changed? And so you're never going to be left there thinking, well, I kind of forgot about it. I'm looking at this system now. And so that's all I got to do, right? Is just, click on the buy and sell line. I mean, buy and sell arrows, because that really is much better than anything else. It's so much easier. This way, you'll always be reminded of whether you should be a buyer or seller. So let's look at some stocks here. Let's look at Netflix, all right? Price was above the fluid buy sell line. And then look what happened here. Obviously some news or some event happened. And once we went below, we continue to be low up until Friday. And even though we had, look at one close above, another close above, not enough to tell us to start going long. And look what happened immediately after that. This is a perfect example of why we say you need at least 3 to 5 closes either above or below the fluid buy sell line before you can change your perspective. Now here you had 3 closes below. So from this point on, you should only be looking at this from a seller's point of view. And so far, it really hasn't done anything. So you wouldn't have wasted any money trying to be long. Let's look at GLD. That's the ETF for gold, okay? Same process applies right here. We apply our chart. As you can see, someone would say, well, Steve, you know, I like to look at economic conditions. I like to look at what's going on with the world and things in the news to tell me what's going to happen to gold. Sure, you can do that if you want, but this is a lot simpler. You know, if you want to look at fundamental news and look at all the things that are going on fundamentally and around the world and see if gold is valuable or not, sure, make your trading as complicated as you want to. It doesn't take a lot of effort to do that, but it really takes a lot of effort just to simplify. And simplifying means basically stripping away all these worn out, you know, consistent methods. Just use things that work, and they're very simple. For example, even back here, when the ETF was trading around 150, we knew that we should continue looking at this from a buyer's perspective. We have 2 closes below, not enough, and look at it, went right back up. Now, once you had closes below here, we are in a seller's bias or seller's mode. Doesn't mean we're going to sell at the market. Just means you have to have some type of method that gives you structure, giving you sell signals, okay? We had a couple of closes above, right back down below. So until we have consecutive closes above, we're not considering going long gold. Okay, let's look at EA. Excuse me, I felt that sneeze coming, and I felt it was probably better to let it out than to try and hold back that sneeze. All right, obviously, we're above the fluid buy sell line. And what happened right here? Now we have consecutive closes. So is that telling us to try and pick a bottom here? Well, look at it. If you tried to pick a bottom, you'd have to be very quick. Let's say that guy in the chat room said to buy right here, and you buy it. And a couple of weeks later, you've made a nice little 4 or 5 points. But if you're holding on to this for the long term, look what happened. All right? You see how the odds are not in your favor? And look what happened. Actually, every time you bounced, this was a selling opportunity because price went right back down again. It bounces. It would be much better to look at this as selling opportunity. Look at this 3-day bounce here, right back down. So this is why you will have the odds in your favor if you are in sync with the market. How about Costco? Okay, here's another example we see. And I want to tell you about something. This is a phenomenon we see a lot of times. That price this entire time has been above the 50-period fluid buy sell line. But look at this. This is something we see a lot, and this is not something guaranteed, but it's a phenomenon we see a lot. Price will come right down to that 50 and stop and reverse and make higher highs. It did it once there. It did it once here. It's almost like a magnet. It pulls it down right to it, and it bounces. Pulls it down right to it again, and bounces. So we're not saying that this is a system, a strategy, and that every time it hits there, you should buy it. But this is something to look at. Remember, you're in charge of your own trading. Look at these things. Experiment. I want and encourage all of our students around the world to look at all these things, to get back to us and see if you found something that works for you. This is how you become consistent, not by blindly listening to some guy in a webinar tell you what to buy or what to sell. You should be making your own trading decisions. Our job as an educator is to provide our students with all the edges and techniques that have high levels of consistency so that you can make those decisions on your own. As we look at VLO right here, obviously we're in the sell mode, right? Every time we bounced, look at how price came back lower. We bounced again, much lower. Bounce, lower. Bounce, lower. Until ultimately we broke through. Now, 1 day above is not enough, but we have 1, 2, 3, 4, 5 closes above. So which perspective should you have now? Well, until you go back in the sell zone, you should have a buyer's perspective in this stock. And we're not telling you where to buy or when you should buy. It's up to you. But this is what the buy-sell line teaches. Okay, TXT, Textron. As you can see, look how price was touching this phenomenon again, right? Touching the 50-period moving average. And then this time it broke through. 1, 2, 3, 4, 5 closes above. And that was enough. And You see how price is now much better traded with a buyer's bias. Once again, you're putting the odds in your favor. This is not guaranteed, because sometimes you'll see some whipsaws in some whipsaw market. It'll go above for 3 bars, go back below for 5 bars, go back above for 5 bars, back below. But oftentimes, this really will put an edge in your favor. GPS, do you see how we're below the buy-sell line? Do you see how the best thing to do is either stay away from purchasing this, or if you're more aggressive, look to short it? But once we had consecutive closes above, right here when the stock was trading at $9, $10, don't you see how this edge could have helped you? I mean, look at this. So many traders like to play the victim game and say, God, I missed this one. I was thinking about buying this down when it was about 5 or 6, but, who knew? Well, actually, you did know that at least you had a buyer's perspective. It didn't tell you exactly when to buy, but look at how this edge can really put the odds in your favor. As we look at DVN right here, once again, the phenomenon of touching the 50 and then backing off, touching it, backing off. But this time it touched it. We had 4 consecutive closes above. That's enough. And look what happened. Off to the races. It's that simple. Trading is that simple. It doesn't have to be complicated. I know a lot of things when I was first learning said, if you buy this one indicator, it only costs $10,000. It tells you exactly what the market wants to do. And trust me, I went out and spent all that money. And 40 years ago, $10,000 was worth about $50,000. So I wasted a lot of money and time searching for that holy grail when it's right here in front of you. It's the 50-period moving average. I often tell my students, if I were stranded on a desert island and I could only use one of the tools, the dozens of tools I teach our students around the world, it would be this, because this tool has helped me so much. It's kept me out of trouble as well. NOC, okay, Northrop Grumman, we're above the buy-sell line. We have one close above, one close below, one back above, but then we have consecutive closes below right here, trading around 325, 330. Do you think you could have holding on to a long position? Why would you want to? Now, once again, we're looking as if we're doing that phenomenon where we touch the 50, we bounce off, we've touched it again, it looks as if we're bouncing off, but who knows? It's just a very odd pattern that we see happening over and over again. All right, now we all know that there was news in mRNA, Moderna, this past week or so, okay, telling us that most likely there's going to be a vaccine and having really good high positivity rate. In fact, this news came out right here. I believe this was on the 16th, all right? This is where traders usually jump in. They say, gosh, that's really good news. You've got to invest in that company. I'll buy it. And they bought it roughly about $100. But look at back here. We were originally below the buy-sell line, and then we have 1, 2, 3, 4 closes, consecutive closes above. One below and then right back above. So right here, when the stock was trading 30 points lower, you were given a clue, not by me, not by the earnings, not by some guy in a trading room or a chat room, not by some so-called trading guru on TV, not by the jobless claims, but by the chart in front of you, the source. It's telling you it wants to go higher. So why would you listen to those things? Remember, the main reason traders fail is because they're out of sync with the market. Why are you out of sync? Because you're putting your trust and your faith in listening to outside sources to make your decisions for you. Make your own decision. Listen to the market. Look at the market. It's right here in front of you. It's telling you it wanted to go higher. So all you had to do was, well, you could have looked at this phenomenon again. We're up there. We come right back down and touch. We bounce. And look what happened. Okay? So you never have to play that victim role once you have this tool in your back pocket. And what victim role is that? That's the role that most traders like to say is, gosh, I wish I would have knew that stock was going up. Man, I was following it, but I didn't get a clear-cut sign that it wanted to go higher. Well, now you don't have to play that victim anymore, because once again, you'll see right here, it was telling you it wanted to go higher. Here's a chart in Zoom. As we can see, we're originally above the 50-period moving average. All right, right here, we had consecutive closes above, roughly at 270. Went all the way up 200 points to 570. Or 300 points. What am I doing? My math is off today. Now, it came down, it touched that 50-period moving average, had a bounce, but then look what has happened. It's now below. So the buy-sell line is telling you to have a seller's perspective. Okay. Now, are we telling you to sell this at the market on Monday? No. You have to add structure in terms of a strategy. And if you look at our platform, we have tons of strategies, all these different strategies you can apply. That's the beauty of our platform. You can first find out what the bias is, then you can apply any strategy to trade in sync with that bias. But today we're just talking about step one, finding out whether you should be a buyer or a seller with the buy-sell line, the fluid buy-sell line. Lastly, look at Apple here. Apple was originally above, then roughly right here. This was in mid-October. It gave us a seller's bias, but then bounced right back up. And in the first week of November, we have 1, 2, 3, 4, 5 closes. So right now, the buy-sell line, the fluid buy-sell line, is currently saying that you should be viewing Apple from a buyer's perspective. Does it mean to buy at the market on Monday? Absolutely not. You have to have a strategy or some type of method generate a signal. But this is just telling you what the perspective you should have, okay? Okay, let's go back to the presentation. Remember, we shared all these examples strictly for educational purposes only. So let's recap before we go into question and answer portion. Always apply the buy-sell line. I don't care what strategy you're trading. It could be someone else's strategy. It could be something you made up. It could be based on the full moon. I don't care. But you must add the buy-sell line. That means plot a 50-period moving average on the chart, regardless of what time frame, regardless of what market. It could be Bitcoin. It could be E-mini futures, a tick chart. It could be a weekly chart of the British pound. It doesn't matter. You should have the buy-sell line plotted. And then once you plot it, the buy-sell line, once again, is the 50-period simple moving average. So just in case some of you are still wondering what it is, it's just the 50-period moving average. And then once you plot that 50-period, ask yourself that question. And remember, I suggest to our new students to always write this on a Post-it and put it on your screen. And that question is, where is price in relation to the buy-sell line? If price is above, you'll have a buyer's perspective. If price is below, you'll have a seller's perspective. Remember, you need at least 3 to 5 closes, either above or below, to generate which perspective you should have. Remember, as my mentors taught me, I'm trying to instill this into you today. Being consistently out of sync with the market is the root of all your losses. You cannot be a consistent trader. You cannot be trading for not just a couple of good months, but maybe a couple of good decades, 3, 4, 5 decades. If you are out of sync, if you're buying when the market wants to go lower, if you're selling when the market wants to go higher, you will be consistent. You will be able to sustain yourself if you are in sync with the market. If you're not, you'll see it's at the root of all your losses. Okay, we have a great discount for all of you taking time out of your Saturday morning to come to this educational presentation. We're going to offer you our bootcamp course. This is all based on trend trading. There's a lot more tips, techniques, and edges included in this course. We're going to talk about entries, exits, and stops. We're going to talk about aggressive trading as well as conservative trading, okay? This is our trend trading special. We're not going to stop there, though. This is, by itself, a really extremely powerful course. But we're also going to throw in a little bit of structure in terms of strategy number 1. Remember, we talked about the first thing you have to do is determine how to find the trend. Now, there are different types of trend: overall trend, short-term trend, sideways trend. But once you learn how to determine that, then you have to add structure in the terms of some type of strategy. Well, we're giving you strategy number 1. This is probably our most consistent pullback method. If you're not sure what a pullback method is, let's say you have an overall uptrend. Well, most traders, when they see a price start to decline, they'll say, hey, I better sell. This is going to come down lower, or I don't know how low it's going to go. But a pullback trader finds that and views that as a buying opportunity. For example, as we look at this chart right here, in the older chart of the spiders, it was doing very well on the upside, and then all of a sudden we started to have 1, 2, 3, 4 downward closes, and then another downward close day here. Even though it closed up on the day, it closed lower than the previous day. Most traders would say, hey, we got to get out of this, right? This is a good day to sell. We're in a downtrend. But according to strategy number 1 rules, which you'll learn in the course, it actually generated a buy signal. Why? Because you were in sync with the overall trend. The overall trend was still up. Remember how we showed you the buy-sell line? Even when prices were selling off, if you're above the buy-sell line, the overall trend is still up. So a buy signal was generated, and the stock went up 8 points. Now, it doesn't seem like a lot. That's not a big gain for a stock. But remember, this represents the S&P 500. And if you transfer that over into the Dow, that was comparable to nearly 700 points in the Dow in just about a week. So this is a great, great method. We're throwing in all the rules. We're going to throw in the course to strategy number 1. But we're going to include some extra bonus here. In fact, we're giving you a total of 12 trend trading bonuses. Let me go through them real quickly. Obviously, you're getting the Trend Trading Bootcamp online course. You're getting strategy number 1. But we're going to throw in our entries course, our exit course, our stop placement course, and our buy-sell line scanner. You can scan for stocks whether they're above the buy-sell line or below the buy-sell line. We're also going to throw in bonus number 7, our top-bottom percent strength scanner. This is a scan for a short-term way to identify the trend through a pattern recognition, okay? You're going to be able to scan for signals on strategy number 1. So every night you'll be able to see if there's a buy or a sell signal on strategy number 1, okay? You'll get a multi-scanner. So you can scan for other edges and other strategy techniques, okay? You'll also get auto-click chart entry and exit tools, okay? You'll get the add-ons. Let's say you want to apply your own platform like TradeStation or MetaStock. You'll get the up and down arrows for those strategy signals and for the buy-sell line. But here's, I think, bonus number 12, the most important bonus. You're going to get 6 months of our PTS Primo charting platform. Okay, this is usually a $900 value. We're going to throw this in. So there's so many things and so many other bonuses included just on the PTS Primo charting platform. For example, you'll get the 4 different ways to view the buy-sell line. You'll get pullback strategy 1, obviously. Our proprietary exit levels, which are automatically generated on the platform. You won't find them anywhere else. You'll get our top bottom 25% tool, which tells you the short-term trend. Signal scanners, which we went over. Strength of trend tool. This is a tool that has the uncanny ability to find out if a trend is running out of steam. So even though you may have the price of a stock or a future or currency pair well above the buy-sell line, this tool is designed to tell you if it's running out of gas or not. So maybe you want to exit before the price starts to fall. And this all comes with personalized tech support. If you ever have an issue, you can't load a chart or watch a video, our tech support will be there in a matter of moments to resolve any issue you may have. Remember, 6 months, we're going to throw in 6 months. This usually costs close to $900. Absolutely free. 6 months free. So you can use all the extra bonuses, the strategies, the bootcamp course, absolutely free on our platform. All right, let's break this down, all right? We're going to throw in the PTS Primo Charts Bootcamp. We're going to throw in strategy number 1, a great strategy, our most consistent pullback method. And we're going to throw in 6 months of the platform, okay? This all comes also with educational correspondence. That means you'll get my private email address. If you ever want to contact me with a question, you're not sure if you're doing things right, if you're actually generating a signal correctly by what you're viewing, just send me an email. Send me a snapshot of the chart you're looking at, and I'll be able to answer it in a matter of moments for you, okay? All right, now if you purchase all these things separately, which you can through Pro Trader Strategies, it would normally cost you over $8,400, okay? Here's the great discount we have for you today, and for today only. We're going to discount it down from $8,400 to $297. Less than $300, you'll get all of these, the 12 bonuses, the bootcamp course, the strategy number 1, along with 6 months of the platform for free. Remember, this would normally cost you over $8,400. You're going to save $8,100 in savings, okay? $297. But you have to make the decision quickly because this is just too valuable just to give away. So here's how to take advantage of this. And remember, a year from today, you will have wished you became a member of these courses. There's over 40 years, 4 decades of information, things I've accumulated right here in this course for you for less than $300, okay? Contact Pro Trader Strategies. I teamed up with them. We developed the platform. We developed all our online courses together. They're in charge of all the pricing, all the discount, and all the tech support. I'm in charge of all the teaching and all the trading of the methods. So if you have a question about purchasing or a question about tech support, I would actually suggest calling them up directly. They have trained consultants manning the phones right now. There's absolutely no obligation. You can call them at 310-598-6677. Now, if you're ready to come on board and be a student of mine, that link you see at the very bottom will take you to the information page. You can sign up online, or if you'd like to, you can call Pro Trader Strategies and sign up over the phone with them. Now, I just posted a link to that sign-up page on the chat box. If you look there, I believe it's posted. Yeah, there's a live link posted in the chat box. So all you have to do is go there and scroll down, and that is a live link. So the link you see on the screen is not live, but there's one in the chat box right now. Now, I promised you I would reserve the last 5 or so minutes for questions. So if you have any questions, just go to the question and answer box, type them in, and I'll answer them to the best of my ability. Why simple moving average? Well, once again, we encourage all of our students to experiment. These are not systems. In other words, there's no statistics behind them. I even stated in the very opening portion of this presentation that I really never look at statistics. We don't believe in statistics, except the one where most traders fail, 80%. But since there are no statistics, we want you to experiment, to research. Now, I've done that. My mentors taught me that it should be a 50-period moving average, and I did experimentation with exponential moving average, weighted moving average, different time frames, crossovers, and guess what? Over decades of the research, the 50 seems to be the best, and the reason is because it keeps things simple. For example, we don't want to be looking at a tick chart of the E-mini futures and then say, well, you know what, now I'm going to look at a daily chart and then have to change everything and to apply new rules in different conditions because we changed the time frame, or maybe we even changed the market. The beauty of the 50-period moving average is that it can easily transfer onto any market or time frame. Doesn't matter what market, doesn't matter what time frame. So in other words, if I'm looking at a 5-minute chart of a stock, most traders would say, well, okay, I guess since I'm looking at a shorter time frame, I should only be looking at a 5 or a 10 period moving average because I'll apply a shorter time frame. Sure, you can do that. But then once you start looking at an hourly or daily chart, maybe you'll apply a 30 or a 20 period moving average. And then if you look at a weekly, then you'll go up to a 50 or 100 period movement. You see how complicated things get? The beauty of the 50 period moving average is that it encompasses all of those different time frames. You don't have to switch anything just because you're switching time frames. So feel free to experiment. Use the exponential if you like. Some of our students say, Steve, I feel better with the exponential. That's fine. The main thing we're trying to instill in you is that this is not a system. The main thing is the way you use it. Remember, if price is above, you have a buyer's perspective. If price is below, you have a seller's perspective. If you decide to apply that with a 20-period exponential, that's fine, but still apply the same concept. That's all. Someone is asking, do you have a percentage we use for getting out? I'm not sure what you mean, percentage of what. Do you mean, do we have a statistic for getting out? We have, in our courses, we have upwards of 7 different exit points. So maybe that's what you mean. But we have many, many ways to exit. But I'm not sure if you could maybe clarify what you mean by a percentage, okay? Question, what time frame do you suggest for day trading? Well, this goes back to the very concept of this presentation. Remember, I said about an hour ago, I said, if you come here for me telling you what I think the perfect time frame is, you come to the wrong place. That's for our students to decide. And I'm not trying to be facetious. I'm not trying to be arrogant or condescending, but trust me, we have students that swear by a 5-minute time frame for day trading. And then on top of that, we have other students that swear for tick charts. Then on top of that, we have other students that say, no, the best time frame to day trade is an hourly time frame. Now, they all can't be right, but here's the difference. They are right for themselves. In other words, someone trading the hourly chart will get less signals than someone trading a 5-minute chart. That just stands to reason. That's physics. You'll have less bars. And maybe they only want to trade once a day, all right? Whereas someone may want to trade 20 times a day. That's why they feel the 5-minute time frame is the best. So what it all comes down to is that you have to make that decision. My standard answer is the right time frame is the one that makes you feel the most comfortable. I can't sit here and tell you that it's going to be the 20 tick is the best time frame for intraday trading. That may work well for someone, but it may not work well for someone else. You have to make that decision, okay? Okay, here's the clarification. I guess me knowing when you're still right or are you wrong for exiting. Well, remember, when we say right or wrong, we're not talking about, the buy-sell line is simply a perspective, okay? When we go on to be right or wrong, we have to add some structure with strategies. That's an entirely different class, and we provide strategies for all of our students. In fact, with this 297, you're getting the exit strategies with strategy number 1, upwards of 7 different exit strategies. So basically, if you're looking for percentages of that, it all depends on how you place your entry, how you place your stop, and there are literally dozens, if not hundreds of ways to trade it. And since we're not a statistical company, I'm sorry, I can't give you a percentage, but Once again, we don't believe in that because I've traded and I've taught percentages before with statistics, and they've all failed. And that's why I really don't believe in stats. I think what's more important is that you, as I answered in the last question, you make yourself feel comfortable by your decisions, and ultimately things will fall in place. That's what we're trying to instill in all our traders, okay? I noticed for the downside that you look for 3 bars below the buy-sell line, but for long bias, you are looking for 5 bars to close above. Is this correct? No, that was just, you just saw those in the examples. It can be either one. It can be 3 or 5. And remember, it's up to you. Some of our students are more conservative and they say, Steve, I look for 5 to 8 bars above. Well, that's fine. Once again, this goes back to the concept of you being in charge and you making your own decisions. This was just a rule of thumb. Some you might see 3 below, 3 above. It all depends on how you want to trade. In the end, it's how you make your decision, okay? That's why I said at the beginning, you know, most traders fail. They're blindly giving away their, the power to someone, tell them what to buy or what to sell. Just because it's 3 or 5 doesn't mean that's a system or it's up to you how you want to view it, okay? Let's see here, any more? Good questions, though. These are very, in-depth questions. They're not something that is things that are standard. And I guess the main thing, there's a common theme here is that, and don't worry, this is the way we're all taught. We all want to know what's the best time frame. Okay, how many bars above, 3 or 5? Okay, what's the percentage? Do you see how the common theme there is, tell me exactly what it is. Unfortunately, that's not the way trading is. Trading is probably about 70% rule-based, but 30% of it is subjective. You know, so I know you all want concrete answers, black and white, cut and dry answers. It's not like that. Trading is 70% rule-based, which is what we teach our students, and then 30% discretionary. Now, I know a lot of you will say, well, Steve, discretionary, I don't have enough knowledge and experience to make a discretionary move or decision. I want you to tell me. Remember, that would be doing you a disservice. We can teach you different things to look at, but ultimately you've got to make the decision because everyone's different. I always give this example. When I left the floor in the 90s, I started trading by myself, and I had a number of students that wanted to learn how to day trade. I wasn't teaching that. I was just trading for my own account and for an account I manage. And so I showed them exactly what I did. They came over to my office. I showed them what I did. And later on in the month, I checked back and saw how they were doing because I had a really nice week. And I said, hey, you must have had a good week because you learned the same thing I'm doing. And one trader lost money. The other one couldn't pull the trigger, didn't make any trades. And I said, why? And the one who couldn't make the trade said, you know what? There are just too many signals. I get too nervous. I can't trade this way. And the other one overthought it and tried to get in too early, tried to get in too late, was second guessing the method. And do you see what I mean? The method that I trade wasn't the right one for them. After we talked for a while, we found out that the trader who couldn't even pull the trigger was not even a day trader. He was more inclined to be a swing trader, someone who holds on for a week to even a month. Once we changed the time frames, the trader started to become successful and consistent. The other trader was trading an entirely different wrong market, okay? Once he found out the market that he liked, then he started to become consistent. So you see, no two traders should ever trade alike. You have to find your own way. I know you don't want to hear that. You want to have a magic pill and have someone tell you this is just follow these rules and you'll be making $1 million and you'll retire next year. But it doesn't work that way. Someone can show you the way. Someone can give you directions and lead you along. But ultimately, you have to find your own way and make your own decisions. I'm sorry, but that's just the great truth of trading. Okay. Final question here. With so many stocks to watch, how many are you watching to see when the 50-day moving average creates a signal? Remember, once again, the 50-period moving average does not create a signal. Only strategies create signals because a signal means where you're going to enter and where you're going to exit or where you're going to buy or sell. The 50-period moving average only creates the bias you should have. And that tells you whether you should look at a buy strategy or a sell strategy. Okay? So first of all, a signal is something you use to enter the market or to sell the market. That's not what the 50-period moving average does. It just gives you a perspective. So how many do you need to watch? Well, the beauty of this offer I'm going to be sharing with you is that in probably less than 30 seconds a night, you can scan the entire S&P 500 and find out which stocks are above the 50 and which stocks are below. It takes you less than 30 seconds. And you'll be able to go through that list and see what you want. You can say, well, these are, $200 stocks. I don't want to trade those. So just pass them. Maybe look for stocks only $20 or $30. So it's that simple. We really made things simple for you so that you don't have to do what I did some 40 years ago. We didn't have scanners. We didn't even have charts. We didn't have platforms. All we had were paper charts. So I had to go through an entire list of 500 stocks almost on a nightly basis, looking for setups, using these rules. So it's so simple because we really want to help you become a consistent trader. That's our goal, all right? So if there's one thing you learned today, it's the power of the buy-sell line or the 50-period simple moving average. Remember, go back and do the research. If you're still not convinced, go back, look at your last 10 or 20 trades. I can almost guarantee you that the reason why you lost is because you were out of sync with the market. And remember, as my mentors taught me, the root of all your losses is being out of sync with the market, okay? Now, with that stated, remember, if you're interested at all, contact Pro Trader Strategies. I would give them a call at 310-598-6677. There's absolutely no obligation. They would be happy to answer any questions concerning pricing or tech support with the platform. And if you'd like to give them your order, they will be happy to do that, but there's absolutely no obligation. As we close here and take one last look at our disclaimer, remember, please use this tool in any market, any time frame. Go back and do the research. But if you'd like to have over 4 decades of tips, tools, and strategies that I've accumulated that I currently use in my own personal trading, take advantage of this $297 offer. It's only good for 24 hours. I'm sure if Pro Trader Strategies wanted to give you time, they'd let you wait till Monday morning. But after that, you don't want to be spending $8,400, okay? Take advantage of this great offer. Take your trading up to the next level. Start 2021 in the right direction. And I'll be there right alongside with you as your mentor. You can ask me any question you like via email, okay? Thank you so much for taking time out of your Saturday. I wish you great trading success, and I look forward to all of you becoming students of mine at Pro Trader Strategies and Specialist Trading. Have a great weekend. I'll see you next time. Bye-bye.